probably have
It's always aggressive.
but I don't know.
I know, it's like so unnecessary. They just relax.
But we're not going to see it on Saturday either.
Funny how you have days where like I have lunch at 5 today, nothing else, and then tomorrow I have ones literally from 8:30 a.m. with one group, and then at 12 to 2 with another group, and then 3 to 5 with another group. Love that for you.
I only have like 2 buyers right now.
I have 3. And one I've been showing some smells on the ground, the $150,000 buyer's lien. I'm sure I talked about them to you. He wants like a house in Anoka. Cool.
Crystal is an hour lead for less than $100,000.
We have an offer out, we're expecting a counter offer. Please let it be good. Please.
I can't believe these people are counter offering at less than $100,000 a place.
Well, we offered 15 grand under asking price plus closing.
It's over 100,000. So
Is it over?
45.
Oh.
Well, that's the.
This one's
offer, yeah.
140. I don't know if that.
Is it the Zillow lead?
Yep.
Might be you, so similar.
Yeah, and I've been showing him since November.
Good thing.
Cool. Like everywhere.
But you know what? If you take really good care of them, they'll refer you. to
He's
something.
already said to me, he's like, thank you so much for everything you do. He's like,
Right.
you're working your ass off for me.
Right.
He goes, because he's a painter. He's like, I will paint 3 to 4 rooms in your house for free anytime you want. I'm
Oh,
like,
there you go.
yeah. We'll definitely take him up on that.
And then like, give them your business card. Then,
Yeah.
those are the ones, like, the people that I help that have actually needed help are the ones that have loved me the most.
Yeah.
And like. have referred me the most.
I know, I feel like I know his whole family personally.
You guys
now.
ready to get going?
Holly, I'm ready. Whatever you want. I am leaning on you for our starting gun.
Pew pew. Let's go.
Okay. Hey, thanks to everybody who's either on the Zoom channel or there in the office. Hope it was an awesome social media training with Hannah and Caitlin. Absolute dream team. Bummed that I did not make that one. Probably could have picked up some things, but certainly some cool stuff there. Let's talk about rehab and renovation loans. This is a popular topic because of a couple of reasons. Number one, you look at what the average age of a home in the United States, which is where these metrics are typically, you talk about 36 years old, right? So, I mean, when you go on showings and you see properties that need some work, whether it be a little bit of work, moderate work, or a lot of work, you know, you'll often get questions of, hey, is there any way that we can roll costs into the loan? And the answer is yes. There are a number of products out there that will allow you to finance construction costs as part of the overall mortgage. I think that they have been a very neglected part of the mortgage business for quite some time. I think people consider them to be a total pain. I think a lot of people want to DIY the work, and that's something that's not entirely allowable. But it's interesting as we start to have more of this generation of new home buyers that's coming into the market, and they have been very much exposed to HGTV and Fixer Upper and Chip and Joanna and things of that nature, that they certainly have their eyes open about things that can be done to buy a property at perhaps a lower price point and then try and create some instant equity. So I wanted to thank Allie, who is on this, right? Hey, Allie, what's up? Allie had, you could say hi, by the way. I see you on mute. Allie had a property that was in, okay, now I need to unmute again. Where was it? Was it in Prior Lake?
Yeah, it was in Prior Lake.
It was in Prior Lake. It had been bought by a contractor and it needed a significant amount of work. The contractor had basically not finished the flip. They had started the flip. They did a complete gut of the property. And so that got our wheels spinning with myself and Allie and Matt on our team to talk about, you know, what do rehab loans really look like? So let's dive into this a little bit if I can get my slide to go. We're going to talk about FHA and we're going to talk about conventional options. We're going to start with FHA. This is the product that has been around for the most amount of time, for lack of a better phrase. It's an FHA 203K. All right, you think about your standard FHA loan, that's a 203B as in Bravo. This is a K. And I always say K like construction, which of course is spelled with a C, but that's how you remember it. 203K is a rehab loan. This will allow you to finance both the base price of the home plus the repairs that are done on the property. I'll give you an example. You've got a $200,000 home. You've got total project costs that are laid out by a contractor for 25 grand, right? And then, you ultimately are able to still use the minimum down payment of what the end value is. Here's how this works. You use something called an after repair value appraisal. What happens is that the appraiser is going to come in. The appraiser is going to say, wow, this property is pretty beat up, but I see this is a renovation loan. Do you have the contractor's bids? Yes, I have the contractor's bids right here, Mr. or Ms. Appraiser. Please see these. Oh, okay, I see they're doing work for $25,000. All right, great. What I'm going to do is I'm going to appraise the home as it is right now. And then I'm also going to appraise what the final valuation is going to be once I factor in the contractor's bids. Okay. And so that after repair value will allow you to roll in the base price and the repairs, and then have a down payment that is based on whatever that end valuation is. Okay. So if you look at this example on your screen, 200 plus 25 grand, you would now have essentially, this is a zero equity scenario, but you are essentially rolling in, which would be $25,000 out of your pocket or in a home equity line or whatever. You've rolled those costs into the new loan. Now, that's not to say that you could have $50,000 worth of work that might create $100,000 in value, right? And again, if that after repair value exceeds what the costs of doing the project are, then you have created instant equity in the property. You follow my math and example there. Is everybody following? Any questions so far? So 203K, you look at some pros and cons here. You've got, yes, this is great for a fixer upper. The property still needs to be in minimal, there cannot be any safety issues, things of that nature. To a certain extent. So you can't have a completely dilapidated home that's probably not going to fly 203K. Again, you look at $30,000 in remodel costs. I want to get into that in the next slide. 3.5% down payment. You're going to build equity quickly. The thing is, with any kind of rehab or renovation loan, lenders really do not like you doing any of the work yourself. And I mean, pretty much any of the work. I mean, you might get away with some painting here and there. But for the most part, if they're going to give you a loan for both the base price of the home and the work that is done, they're going to want to make sure that the work is in the hands of a licensed contractor. If you look at the lower left of your screen here, you're going to see roughly what the timeline is looking like for the 7 steps in this process. You're going to apply for a loan with a 203K approved lender. A lot of lenders do not do 203K loans. I know when I worked at Bell, we did not do 203Ks. And that's, I mean, Bell probably has about 25% purchase market share in the Twin Cities. So it's not necessarily a big or small thing. Some companies just choose not to do 203Ks. You get approved for the loan. You choose a contractor. The contractor is going to give you bids. You're going to close on the property before the work is done. Then the contractor begins work, right? I mean, you can't begin work on a home that's not technically yours that you haven't taken title to yet, right? And then once the repairs are done, you're going to move in. That's a 7-step process to how the timeline of a 203K is going to work. So let's get into the nuts and bolts of these 203Ks for a moment.
Hey, Colin, can I ask a quick question? at least for it to be answered later. I don't know if it's the right time, but how long generally does it take to get those contractors come out for the bid?
Depends on how good your contractor is.
Gotcha.
Yeah, so the thought that
Like
I
I'm
would,
thinking timing wise for the offer, you know, to know if it would work or not.
yeah, I mean, I think that that is something that, and Holly, maybe this is a seed planted here. You know, I looked at our PHT agent resources page yesterday, because Jen, this is a great question. The I know that we have some contractors that Parker or some other, you know, people on the team have worked with before. But, you know, I wonder what the best process would be for that. You know, I think that typically, a lot of this is done in the inspection period. Now that we have inspections coming back, this is something to, you know, actually broach the subject on, right? Where let's say you have a 7-day inspection period, if you can get a contractor out there to submit, you know, say, hey, look, the work is going to be roughly $50,000 or whatever they say. We want to do this, we want to do this, we want to do this, we want to do this. Okay. And then that, you know, those bids are considered while the property is under contract. I think the only, you know, potential jeopardy there is that you don't get a contractor out there in the amount of time that is necessary, and then you fall out of the inspection period.
That's what I'm thinking. Like, and so if you've now given notice because you have an accepted offer, you know, that's where my brain was kind of going on that. Like, is it feasible to get it during that time period to know you're good? Or is it just one of those?
You know, I mean, I think with DOM, you know, with DOM, like it increasing, right? You know, I mean, I think that provides some opportunity to, you know, explore some of these options versus, you know, trying to write the fastest, right? I mean, if you've got these properties that are in need of repair, if you've got a good listing agent that's going to say, yeah, we'll accept, you know, conventional rehab or you know, FHA 203K, you know, a lot of these properties are going to fall into that category where they have longer DOM, right? And then you know, you can sort of strategize. And also, you know, I think a lot of that depends on what the buyer's appetite is. You know, if the buyer's like, we do not want turnkey, you know, we want you know, we want something that, you know, can be fixed up. I think the most difficult part of that conversation is like, hey, I know you want to do some of the work yourself. You know, you can roll in a lot of these costs for a bathroom and kitchen remodel, for example, but, you know, you do that kind of 80% of the work with a contractor, and you can do the other 20% down the road. So I don't know. And maybe we have, you know, more established relationships, Holly, back to this idea with contractors that might be interested in doing more of this work that are familiar with rehab loans. Just a thought. But let's circle back to that once we've all kind of had some time to chew on it. And I think that we'll get into the nuts and bolts of these
Colin.
203Ks. Yes.
Quickly, what I was thinking when I heard her question is, you have to write the offer with the 203K. I'd be having that conversation on the front end with the listing agent. I'd be writing it for a longer inspection period, maybe 2 weeks instead of a week. And I would be just setting that expectation on the front end so that you're not falling outside of an inspection contingency, and or writing in a separate contingency that is in relation to getting those construction bids and or having them fall within the allowed amount of money that you're able to take out with the 203K, something along those lines. I mean, it's not something you're going to sneak through. It has to be a property that is distressed in some way, shape, or form. I'm
right. That's
thinking
why I'm asking to see
market.
generally, how long does that generally take? the process, like in your guys' experience that have done them, so
Getting a
that we
construction
know.
bid,
Uh-huh.
it can take a day, it can take 2 weeks. It depends on the scope of work and the contractor and your knowledge level and selections. There's way too many factors to even guess on that, I would say. But that's why having that conversation on the front end would be so important in this case.
Okay, cool.
Sorry, I muted you again. Go. Jackson has something to say.
I just did a rehab loan and they hired a general contractor who hired basically all the bids out. It probably took at least a month.
To get numbers.
Yeah, to get numbers from everyone, electrical, plumbing, framing, tile, flooring, cabinets.
That was your commercial deal?
Yeah.
Yeah, so it was commercial on top of that. But it can be really complicated. It's not going to be fast. So I probably wouldn't use the inspection contingency. I think I would write in a separate clause, which we can probably have Liz create language for us on that.
I mean, I think a lot of it depends on, what the work is that you're actually looking to do, right? I mean, how significant the rehab is. And there are two different types of 203Ks, for example. You've got a streamlined 203K, which is pretty easy. You're limited to $5,000 minimum. So you're not going to nickel and dime some $2,000 projects here and there and call it a 203K. You would never do that anyway, because you're going to be subjected to a higher rate. That doesn't make any sense. So $35,000 is going to be the max. I should note that FHA is going to cap you at a certain percentage of that 35K. So that number really is about 31. That's the maximum streamline allowable. What they essentially do is they say, yeah, we'll give you 35K as the allowance, but in case the project runs over budget, we're going to have a 15% hold, which basically knocks you down a little bit to roughly $31,000. Cosmetic, non-structural, non-luxury items. I mean, typically you're going to see kitchen and bathroom remodels. I mean, those are the most popular ones that you're going to see. Appliance, HVAC, carpet, flooring, again, more cosmetic stuff, paint, cosmetic, a roofing replacement, safety and health issues, as long as they're, not totally dilapidation, things like that, energy improvements, septic system improvements. If you have a private well and septic, for example, you get over that number and you're going to be in the standard 203K range. So if you think about just streamline being easier, okay, yeah, we just want to do a little bit of stuff here that's really non-structural, more cosmetic. That's where 203Ks on the streamline side are really going to be advantageous. If you look at the standard 203K, again, you still got that $5,000 minimum. The maximum, well, the max, as long as you are just under that final FHA loan limit, right? Which for the county metro area this year, changes year over year, is roughly $420,000, right? So if you buy a $400,000 house and you say, we're going to roll in $100,000 worth of work, you're going to be butting up against that county loan limit in a hurry. So it's something to keep your eye on with higher priced or bigger rehab 203K, potential candidates. Structural alterations are allowed. This is where you talk about things like load bearing walls and things of that nature. You can even use this to convert a single into a duplex or a triplex or a fourplex, or you can go the other way. You can convert a duplex into a single family, for example, using a 203K as an owner occupant. You can connect to public sewer and water. Tony Lawrence had a client that, hey, we are, it's going to cost $25,000 for a public sewer or water system to be connected in Farmington. And so, well, that would be a good option for a 203K loan, for example. Landscaping, they don't necessarily like, but larger landscaping projects are permissible, and then ADA access as well. If you look at what can we not use a 203K for? Minor landscaping, which I just mentioned. If you want to put a big tennis court, a big outdoor kitchen, a swimming pool, those are all considered luxury items that FHA is not going to be okay with. And then project timeline, projects that take more than 180 days, typically are not going to fall within the purview of a 203K. A lot of text here. Any questions on this? Okay. That said, let's talk about some objections to 203K loans. All right, I've got a 780 credit score, but if I'm in a 203K loan, I've got to pay life of loan mortgage insurance with that, less than 10% down payment. I have to pay that for the entire life of the loan, right? I mean, I have, again, typically 680 being the dividing line where, hey, anything below 680 is going to go FHA, anything above 680 is going to go conventional. Somebody sitting there with a 780 credit score say, I don't want to pay life of loan mortgage insurance. FHA is going to charge you 1.75% upfront PMI, right? So, I mean, if you've got a $300,000 loan, you've got a 3.5% down payment. Half of that goes right out the window with that upfront PMI. I don't want to pay for 2 appraisals, which can happen sometimes with 203Ks, right? You've got the base appraisal and you got the ARV. All right. So let's talk about some conventional solutions. And these have become increasingly popular over the past 5 years. Fannie Mae and Freddie Mac have very much gotten more involved in how do we make sure that we have this silver tsunami of baby boomers that are selling properties that need work. And we want to provide more accessible options for especially first-time buyers that want to get into these properties and simply want to do some work. So there are 2 different products. And you've got, guys, just so you know, you've got banks and other institutions that are going to have their own twist on these products that they will portfolio. But, I'm just sticking with kind of what the guideline is from the government sponsored entities, which are Fannie Mae and Freddie Mac. There's home style renovation, which is Fannie Mae's product. And there's choice renovation, which is Freddie Mac's product. Okay. Similar structure with all of these, right? You're going to combine the base price of the home with work that needs to be done on the property. Down payment can be as low as 3%. Typically 5% is a safe guideline in case they were to be over the area median income limit. And if you got projects that are a significant amount of scope or at their higher price point, they're probably going to be outside that area median income where they would be 5% down, but you can go 3%. Lower rates than you're going to see on HELOCs. A lot of times people will say, well, you know what, I'll just get a HELOC on my primary residence. Well, HELOC is going to be tied to prime. It might cost you 6%. Yes, that might be interest only, but maybe people don't want to have 2 mortgages on their home, et cetera. This can be used for a number of different properties. And a lot of people don't know you can use this for primaries. You can use this for second homes. You can even use this for investment properties. So you can do a renovation loan on an investment property with as little as 10% down with these conventional rehab. I'm sorry, with as little as 15% down, 15% down on these properties. You can use this to have luxury improvements. Unlike 203Ks, you want to put a pool in, conventional's cool with that. Again, you've got different property types that are involved. You've got PUDs, you've got single families, you've got multi-families, you've got condos, you've got investment properties. These are all going to be different down payments depending on property types. For example, if you want to rehab a triplex, they're going to hit you with 25% down. Okay. But single families being the most common here, owner occupants, you're going to be in that 3 to 5% down category. And this is a good equity builder. I mean, if you do this the right way, you should be able to get a great ROI on the property as long as the work that you've done is significantly adding value. Let me see. Questions on home style renovation, on renovation choice. I'm almost done, so hit me with a bunch of these questions. It's just an overview on how this is going to look. Jen, it's funny, you still have your hand up in the chat. So I keep thinking you have a question. The cute little hand.
Oh, yeah, I don't even know how to turn that to.
It's okay. It's okay.
Sorry.
The big thing, and Jen, this will circle back to your question, the contractor is key with all of this. A lot of contractors like to be paid up front. you've got a certain amount of the work that is going to be required, okay, hey, look, here's what I'm going to do. I'm going to get 30%, I'm going to get 50%, I'm going to get 10%. I'm going to get a certain portion of the work paid for upfront. Okay. Contractor needs to know, hey, this is a renovation loan. Number one, do you know how to do those? Do you know how those work? Have you done those before? That's going to be a key question when you're potentially screening contractors that might do work on these sorts of projects, right? Do they sub out work, Jackson? That's a great point, right? Are you going to act as the general contractor and then you're going to subcontract plumbing and electrical? And that's cool, but just so you know, Mr. or Miss Contractor, like, you're going to need to play ball with significant amount of paperwork that's involved here. Okay. So do you know you're not going to be paid up front? Do you understand that we're going to need you to communicate effectively with the lender as we go through all of this? Contractors some are really great, some are really terrible. Some will squeeze these jobs in between other jobs and things of that nature. And that simply just will not fly for a renovation loan, because typically the work has to be wrapped up within a certain amount of time. 90 days is typically a good threshold for that. So if you have a contractor that is missing deadlines and things like that, it can be an absolute total mess. So having a good contractor that's well-versed in renovation loans, understands how they work, and then can really communicate effectively can go a long way in making sure that these loans are executed well. Tim Taylor would just be on top of all of this, no doubt. Questions on anything that we've gone over here, whether it be 203Ks, scope of work, conventional rehabs, etc.?
You guys obviously have all of these available for clients, correct?
That's correct.
Okay.
I think it's something that can definitely be a good niche. I heard Crystal's voice. Crystal's been very active in this duplex market. This is just kind of one more thing to add to your tool belt when you're talking with buyers that are looking at maybe not totally distressed properties. Maybe they're properties that are original owners from 1978, right? And there's a certain amount of work that needs to be done. But certainly something that we could talk about. I will tell you, to be 100% honest, I've counseled a number of people that are interested in these programs over the years. I don't know, 4 out of 5 times they're just going to figure out a way to do the work themselves, because they want to do the work themselves. They want to paint. They want to, so it's, it's not something that the buyer is always going to bite on once you tell them they can't do the work themselves, because a lot of people just want to DIY the work, and that just will not fly with a renovation loan. So just one more thing to think about. If you guys have questions along the way, just let me know. Or myself, Matt, John, anything else you can think of before we wrap up the Zoom?
Is there different qualifications for someone? If they qualify FHA, would they qualify for the 203K? If they qualify conventional, would they qualify for these home style renovations and whatnot? Yeah,
so basically it's a credit score requirement question, and then a debt to income requirement question. That's a really good thought, Allie. So if you have a buyer that qualifies for 350, right? You obviously can't buy something that's 330 and do a conventional renovation loan for 60 grand, right? Because that's probably going to put them over their debt to income threshold. So that is something to keep in mind is, okay, do you have a lot of room? Do you want to buy something that's a little bit cheaper and roll in these costs and then still be below what your overall approval max is? So that's the debt to income part of it. And then the other part of it is credit score. So, typically 203Ks, look, if you're at a 590 FICO score, like, it's going to be difficult for you to do an FHA 203K, but typically 640 is a good starting point for FHA 203Ks for the minimum credit score requirement. For conventional loans, typically 700 is a benchmark. And I say that because lenders will go in and out of those credit score requirements. So I don't mean to be vague, but 640 for FHA, 700 for conventional would be good benchmarks, Ally. Good question.
Okay.
Okay. Thanks everybody for being on this.
Colin. Colin,
Jackson.
are the interest rates the same or different?
Yeah, that's a good question. So rates are going to be a little bit higher, maybe 3/8 of a point, half a point higher than what you're going to find out there. Essentially, what the lender is saying is, hey, you know, this is not an as-is move-in property. You know, stuff can go wrong with the contractor. You start opening up walls, you do structural things to the property. You know, now our collateral is a total mess. So that risk is factored into the rate. So typically you're going to find 3/8 to half a point higher than what you would find on the general market. And that's where a good lender is going to do a comparison to, you know, maybe you have a well-heeled borrower that is selling one property, wants to do a move up. They've got a huge amount of cash. You know, maybe you just want to use the cash because you don't want to be, you know, at a higher interest rate for the next 5, 10, 20, 30 years, you know, for work that you might be able to finance yourself. So that's just a cost benefit analysis of, are you cool with, you know, are you cool with a higher interest rate? Or maybe it's, hey, if you want to go half a point higher, you can roll in 50 grand worth of work. And you could always, you know, look at refinancing the property later. But yeah, good question. You are going to have a little bit of risk priced into those rates. All right. Thanks, everybody.
Thank you.
Thanks, Colin.
Thank you.
Thanks, guys. See you soon.